Oil prices expand profits as weaker greenback. Tight elements help Singapore oil expenses prolong profits on Monday, propped up by means of a weaker dollar and tight supplies that offset concerns about recession and the chance of widespread COVID-19 lockdowns in China, once more reducing gasoline call for. Brent crude futures for September settlement rose 69 cents, or 0.7%, to $101.85 a barrel by means of 0421 GMT, after a 2.1% advantage on Friday. U.S. West Texas Intermediate (WTI) crude futures for August delivery edged up 27 cents, or 0.3%, to $97.86 a barrel, after hiking 1.9% inside the previous session. The U.S. dollar retreated from multi-year highs on Monday, helping expenses of commodities ranging from gold to oil. A weaker dollar makes dollar-denominated commodities more low-cost for holders of other currencies. Last week, Brent and WTI published their biggest weekly drops in approximately a month on fears of a recession that will hit oil demand. Mass COVID testing sporting activities continued in components of China this week, raising oil demand concerns at the sector's second large street oil patron. However, oil substances remain tight, helping prices. As predicted, U.S. President Joe Biden's journey to Saudi Arabia failed to yield any pledge from the top OPEC manufacturer to boost oil delivery. Biden wants Gulf oil producers to step up output to help tame oil expenses and force down inflation. On Sunday, Amos Hochstein, a senior U.S. State Department advisor for electricity security, mentioned on CBS, Face the Nation that the ride could result in oil manufacturers taking a few greater steps in terms of delivery, even though he did now not say which U.S. or countries might enhance output. While there were no instantaneous pledges for improved oil manufacturing, the U.S. has reportedly indicated an expected sluggish increase in delivery. Baden Moore, head of commodities studies at the National Australian Bank, stated in a word. The wind down of SPR releases from November may additionally offset this incremental supply, although if no longer large than approximately 1 million barrel, in line with day. The next assembly of the Organization of the Petroleum Exporting Countries (OPEC) and allies such as Russia, collectively called OPEC+, on August 3 could be carefully watched as their present output percent expires in September. Global markets are centered this week on the resumption of Russian fuel flows to Europe through the Nord Stream 1 pipeline that is scheduled to cease maintenance on July 21. Governments, markets and groups worry the shutdown can be prolonged due to the battle in Ukraine. Loss of that gasoline could hit Germany, the world's fourth large street economy, difficult and heighten the hazard of a recession. Separately, U.S. Treasury Secretary Janet Yellen stated on Saturday she had effective conferences about a proposed fee cap on Russian oil with a bunch of countries at the sidelines of an assembly of the finance chiefs of the Group of 20 Fundamental Economies. Yellen raised the rate cap idea during a digital assembly on July 5 with Chinese Vice Premier Liu He. China's Trade Ministry mentioned closing week. The ministry had said setting a cap on the Russian oil charge is a very complex trouble, and the precondition to clear up the Ukraine disaster is to sell peace talks amongst applicable parties.